And let's just start out with how the economy is doing. Last time we spoke, we talked about retail, cars, stock markets. Has the economy improved? Things getting worse? From your viewpoint, how is it doing right now?
The economy is at the late stages of an economic advance that started somewhere around 2009. So we're in the late stages. We had some crazy events last year, like the hurricane, which caused people to have to buy new cars and fix homes and all that kind of stuff. So you had, a boost that really wasn't part of the long-term economic plan. Then you had tax cuts, which are now starting to kick in, and you have excess government spending kicking in. So if you think that, if you talk about all these artificial stimulants, and most of them are one-time sugar highs, I think that if you look at the underlying economy, it's actually starting to slow down. We're starting to get, a pickup in car loan delinquencies, mortgage delinquencies, and things of that nature. Prices are starting to go up. Interest rates are going up, which sort of crimp consumer spending. So those things will start to kick in as the year goes on, and some of this, stimulus sort of backs off. We are in the very late stages of a artificially induced economic advance, and when it ends, it's going to end very badly.
So when you say like an artificially induced economy, are you talking about what the Fed has done?
What the Fed has done over the last 8 years, adding $4.5 trillion to the U.S. balance sheet, accompanied by its counterparts around the world, the Bank of Japan, the European Central Bank, the Bank of China, the Swiss National Bank. They've added about $20 trillion worth of liquidity to the markets. And that really basically stimulated the economy. Now things are going to start to reverse. And, the Fed is already starting to shrink its balance sheet very slowly, very small at this point, but they're looking to pick it up. And another fly in the ointment is basically you have three new people, or now two, but soon to be three new people at the head of the Fed. You have Jerome Powell taking Janet Yellen's place. Now, Jerome Powell is probably a lot more hawkish than Janet Yellen. We have a guy nominated, Richard Clarida, is going to take Stanley Fischer's place. And Bill Dudley, the other dove at the head of the Fed, is going to be replaced by John Williams from the San Francisco Fed. So I expect a much more hawkish Fed, and one that will not respond quickly if the stock market starts to decline. And that's where this whole thing is ultimately going to be going. So it's a very precarious time. For the last year, we had, the stock market basically going straight up. So I will refer to that as MOMO. And then you had everybody wanting to jump in, which was FOMO, F-O-M, fear of missing out, which will turn into NOMO, and then no, and then oh no, and then no.
Is the stock market right now, is this an open, free market where people are freely trading, or do you think it's more manipulation that's keeping the market up?
Well, I don't like to use the word manipulation, but the Federal Reserve definitely, through its QE policy, wanted the wealth effect to go up. And the ones that benefit from the wealth effect are the people that own financial assets. And they have significantly benefited. But if you look at the average American, or the average person around the world, they have not benefited over the last 8 years. Their wages are sort of stagnant, and their costs are going higher, and so they haven't benefited. So if this wealth effect starts to reverse, and I think it will, because leverage is coming back into the system, I want to say as bad as '08, but it's not, maybe not quite there yet, but it's getting there. For example, 50% of all corporate bonds issued are now BBB or lower. You have, auto loans given out by subprime lenders. In other words, back to the '08 level, where people that can't afford to buy a car are buying cars with very low interest rates, but they're defaulting at very high levels already. Two auto lenders, of subprime kind of auto lenders, have failed recently. A third one is under severe financial pressure. So is that a one-off, or is that sort of a canary in the coal mine as to what happened in '08? And again, more than 50% of mortgages are now being issued by other than banks. So again, credit standards are being loosened, covenants on bonds are being loosened. So we're setting ourselves up for hopefully not a repeat of '08, but it could happen.
So when you talk about, let's just go back to the stock market for a second. When you talk about the market coming down, are you talking about like a little correction, like 10% or 15%, or do you think it's going to be much larger than that?
Well, barring, Federal Reserve intervention, I think that you could come down 30 to 35%, maybe even more. I always like to look back at Japan in 1989, when, if we were having this conversation back then, we would think that anything you touched that was Japanese was the best thing since sliced bread. And their equivalent of the Dow Jones, the Nikkei, was at 40,000. Today, 30 years later, the Nikkei is at 22,000 or thereabouts. So after 30 years, we're still down 50%. There are very few people in the United States today that think that that is even in the realm of possibility. But yet, if you look at corporate balance sheets that are overloaded with debt at very low interest rates, which are now starting to rise, who knows what can happen? We had crazy things happen in 1929. We had a very big crash in 2000. We had a very big crash in 2008. We don't have those bullets in the gun anymore. So if something really bad happened now, it can unravel very quickly. Margin debt is at an all-time high. So there's a lot of risk in the market because nobody perceives that risk is really important.
Now you mentioned debt, corporate debt, margin debt. What about global debt or the U.S. debt? I mean, it just continually moves higher and higher in the U.S. to like 20 trillion plus. Unfunded liabilities and things like that, maybe 200 trillion. But can all of this debt be sustained? Is it possible for the debt to continually move higher and higher?
As long as somebody's stupid enough to buy it. I guess the answer in a rational way, no, it can't. But just think about it this way. Right now we have, I think it's a 21 trillion at this point, which is up about almost $1 trillion since last September. Like 7-8 months ago. So at 1% interest rate increases the budget deficit by $200 billion. Now, if we normalize interest rates and get back to like 3% or 3.5% on the Fed funds rate, you're talking about a $200 billion budget line going to $600 trillion. Tell me what they're going to cut to balance the budget or get it anywhere in shape. We have to issue an additional $1 trillion worth of debt this year. Now think about that, with the Fed now selling bonds instead of buying bonds. Soon the ECB will start selling bonds instead of buying bonds. This could have a really, really negative effect on everything.
I mean, should we be looking at the bond market? I mean, do you think that would be like a black swan or something, as, the ECB, the Fed, everyone's selling bonds and things like that, and who's going to buy them?
Well, that's a good question. Right now, you still have buyers because a lot of investors are still looking for yield, because for the average investor, yields are still very low. There's 1%, 1.5%. Go to a money market, maybe you get 1% or 1.25% maybe. So people are still looking for vehicles that can give them higher interest rates. But very few people are looking at the risk of those extra yield points. And that's where I think that this is going to unwind. Because like in 2008, we had all those crazy mortgage-backed products. We now have auto loans that are starting to default, which is similar but at a much smaller level. And you're going to get mortgages starting to default again. You're going to have corporations that can't refinance their debt that was currently bought at, let's say, issued at 1 or 2% or whatever. And if they have to pay 2 or 3% more, they will not have the financial ability to borrow the money to stay in business. So you're going to start to see bankruptcies rise over the next year, especially if the Fed stays on course. And I have no reason to doubt that they are going to stay on course. Because if you just read the headlines in today's papers, the economy is strong. Now, the first quarter GDP is estimated by the Federal Reserve Bank of Atlanta to come in about 2%, which is where we've been for the last 9 years. And I think during our last conversation, we talked about, where the GDP growth in the country was, and it's about 2%. We might get a little higher GDP growth in the second quarter and the third quarter due to the tax cuts and the extra spending. But again, that's like a sugar high. Once it goes away, then what? You don't have the sustaining ability of the economy to keep growing. So without stimulus, I don't know what happens.
I mean, you mentioned bankruptcies. I know there's a lot of retail stores. They're declaring bankruptcy. A lot of stores are closing. Actually, we see a corporate bankruptcy on the rise right now also. Now, at the same time, the Fed is raising the rates, and they're expected to raise it a couple more times this year. I mean, what effect is this going to have on the stock market, the bond, the housing market, the auto market, the student loan market? Because, as you raise the rates, everything just costs more. So what happens?
You knock out the marginal buyer. I think that, when I first bought my first house, which is, ancient times, the first rate I paid was 7%. It took, and that was in 1970. It took till 1993 to get interest rates back down to 7%. Now, people in today's world that are buying their first house have never seen them, interest rates above 3% for, 3 to 4% in housing, 3 to 4% on car loans, etc. And most of those people are stretched at those levels because the prices of the assets have gone up. So I think everything slows down dramatically as interest rates start to rise. Now, we haven't seen dramatic increases in interest rates yet, but they're coming. They're coming.
So what is the Fed trying to accomplish here? I mean, if it's going to hurt the housing market and all these different sectors of the economy, why in the world would they raise rates?
Everybody that's a smart economist, and most of the people on the Federal Reserve Board are very, very smart people. I mean, I don't want to denigrate them in any way, shape, or form. But they knew that they were making a devil's bargain back when they did QE1 and QE2 and QE3. They know that was not sustainable. And they knew at some point they would have to get back to a normal economy and normalizing the Fed balance sheet and normalizing interest rates. Well, here we are. Now they have to normalize, or they're trying to normalize at a time where everybody is stretched again to the limit. So they basically have their fingers crossed, and hopefully they're able to pull it off. I think the odds of them pulling it off are very slim.
Now, a lot of people, when they look at the interest rates moving up and they see the devaluation of the dollar and what's happening in the Middle East and countries moving away from the dollar like China, like Russia, many people say that we're going to see inflation here in the United States because those dollars are going to, float back here to the States. And other people are on the other side saying, no, we're going to see deflation. We're not going to see inflation. Where do you see us headed? Are we headed for inflation, deflation? And there's, of course, another train of thought of stagflation. But where do you see us going here?
Stagflation, which is what we had in the 70s, where we had rising inflation and sort of a flattish economy, is probably the best we can hope for at this point. Deflation, I think the Fed and its counterparts around the world, one of the things you hear every quarter when they come out is that we have not reached our inflation goal, which is about 2%. And it's just about 2% now if you look at their core CPI numbers. But if you look at housing, you look at medical care, you look at food prices, and now over the last year, you look at gasoline prices, it's a lot higher than 2%. And, when the average guy goes to the gas station and starts to fill up his gas tank, and it used to be, let's say, $20, and now it's $30, that $10 comes out of some other thing that he's going to buy, because he doesn't have a lot of excess cash. Savings rates in the United States are probably the lowest they've been in 30 to 40 years, somewhere around 3%. So we don't have excess savings to lean on. What people have been doing is using credit cards, which credit card debt has been going up tremendously. And as as more and more people get stretched out to the limit, you're going to start to see, defaults and delinquencies on credit cards rising, which they already have, and will continue, unfortunately. So I think, and now the other wild card is we don't know what's going to happen with this constant talk of trade wars and tariffs and all this kind of stuff. But every time tariffs have been introduced in the past, it means higher prices domestically. So, for example, we put some tariffs on Canadian lumber, and all of a sudden, within the last year or so, lumber prices are up about 30 to 40%. Well, anything you build with lumber goes up. Housing prices go up, and everything else that's lumber associated. Now, again, China's going to put tariffs on stuff that we send to them. We're going to put tariffs on steel and aluminum. Well, all that means is everything that's made with steel and aluminum are going to go up in price. So that to me is inflationary. How bad it gets, hard to tell. But we'll see. It's definitely heading in that direction.
So we mentioned the stock market, we mentioned raising rates, and last time we spoke, we talked about pensions. Now, if a lot of the pensions are invested in the market, they're hoping for a very good return. I think most of the pensions, they're based off maybe a 7 or 8% type of return. And of course, interest rates are very, very low right now. So they had to find other ways of trying to make those type of returns. So if everything starts to fall apart and the market starts to come down, like you said, maybe 20%, 30%, what happens to the pensions? Because I think last time we spoke, most of them are underfunded. So have they fixed the problem? Is anything better now, or are we headed towards a complete and utter disaster?
We can't fix demographics. The problem with most pension funds, when these schemes were designed 30, 40 years ago or whenever, the age of the population in those pension funds was in its 30s. So you had a few people retiring and a lot of people contributing to the pension fund. Now you're getting the reverse. You're getting a lot of people retiring and few people putting in. So as people continue to draw down the assets of a pension fund, they start to get further and further underfunded. And no matter what the stock market does in some cases, it's really going to just maybe prolong the agony for a few more years. In certain places, we are coming down to, near the end of the line. Today, there was an article on Bloomberg about the unsustainability of pension funds. And they used a couple of states. They used the example of New Jersey being one of them. They have something like $78 billion in assets, and they have estimated liabilities of about $280 billion. So, probably within the next 5 to 7 years, we're going to get down to a critical point where something is going to have to be done to the state of New Jersey's pension funds for their teachers, all their public employees. Now, the real problem ultimately is the benefits. Nobody can expect to retire and earn whatever they were earning while they were working for the next 30 to 40 years. I mean, that's just not sustainable. There isn't enough money in the tax base. There aren't enough assets to sell to pay those benefits. So sooner or later, a serious conversation is going to have to be had with a lot of these pension funds. And, whether they have it or not, I don't know. But, there is no way out. We're going to run out of money. And sooner or later, they give you a check and it'll bounce. Social Security is a different issue. To me, Social Security, you can fix if you do a couple of things. One, you raise the age that people can retire at. Number two, you raise the amount of taxes withheld to the last dollar of earnings instead of 110,000 or whatever the number is these days. So, those are fixable. And you start with people that say at 55 and tell people 55, you can't retire at 67, you have to retire at 70. You tell people that at 45, they have to retire at 72 or 73, or whatever the numbers are. You got actuaries that can come up with the right numbers. But those are somewhat fixable. But state pension funds that have people retiring at their full salaries or even inflated salaries because people that earn overtime is counted as their last salary is just not sustainable. So I don't know how it ends, but it's not going to be pretty.
So are you saying that, the pension scenario is so bad that, millions of people, they won't, get income from the pensions that, all those years of working, 20 years, 30 years, whatever it is, when it's time for them to retire, they're just not going to receive their check.
Well, they will get a check. But let's say they were expecting $1. They may not get $1. They may get 60 cents, or they may get 50 cents, or 40 cents. I don't know what that number is, but it's not $1. So if they were counting on $1 for their long-term retirement plan, they better start rethinking what they're going to be getting down the pipe. We're ultimately, they're not going to get zero. They're going to get something less than they're supposed to get. And unfortunately, most people that are retiring, when they're calculating how much money they're going to need to live the way they want to live, they count on getting $1. Now, if they only get 60 cents, that changes their lifestyle dramatically. Unfortunately, that's where we're heading because politicians and the other side, whoever they negotiated with, didn't have spine enough to say, this is ludicrous. We can't do this long term. But everybody said, well, it's not going to happen on my watch. It's going to happen 20 years from now or 30 years from now. So it's not my problem. Well, it's 30 years later, and it is somebody's problem.
I mean, if we take this a step further, if people are, say, they were expecting $1, they're getting 60 cents, this will affect the rest of the economy because if you have, 100,000 or 500,000 or 1 million people who are not getting what they expect, well, they're not going to go spend in retail like they planned on doing. They're not going to buy maybe another house for, retirement or maybe a vacation area or travel or go out to eat. I mean, this is going to affect a lot more than these people just getting what is coming to them. It's going to affect the rest of the country because we have a very big population moving towards retirement.
That's correct. And, if you look at the average 401k or, for those that don't have those cushy pension funds, the average 401k is probably somewhere around $50,000 to $60,000 total. So, I don't know how, that's why you have, so many people back in the workforce or staying in the workforce or getting, jobs like greeters at Walmart or things of that nature just to supplement their retirement, because they just don't have enough money.
Let's move on to what China has done. They have launched the petro-yuan futures market to go up against the petrodollar. Should we be concerned about the petro-yuan futures market? I mean, do you see, countries moving over to this instead of the petrodollar? I mean, I'm not saying right tomorrow or anything like that, but down the line?
Well, I think on our last conversation, I sort of suggested that was coming down the pike, and now they rolled it out in March. Now, clearly, it's not going to affect the dollar tomorrow. But if you just look around the world at the oil production and where it comes from, Russia is a tremendous oil producer, probably number one in the world or number two with Saudi Arabia. So Russia doesn't want dollars because with our sanctions, we can affect their dollar movements. Iran doesn't want dollars. Venezuela doesn't want dollars. So you have a lot of people that would be much happier with another currency. And I don't think the yuan is ready to be the reserve currency of the world. Maybe in 10 or 15 years it will be. But if we don't have the reserve currency in the world, who is going to finance our deficit? We will have to change the way we live because of people having to have dollars. They buy our treasuries, etc. They finance our living standards. And if that slows down and they start putting money in yuan or in gold or in some other form of currency, that's going to hurt the United States long term. Not tomorrow, but every year it will just get worse. And, so I don't, other than war or some other catastrophic event, I don't see any way out for the dollar. We may get a rally this year in the dollar as its last gasp before it collapses, in my opinion.
So you think the dollar is going to collapse? I mean, what do you mean by that?
Well, like right now, I think that if you watch the dollar against, other currencies in the world, it's been falling over the last year. It's not, it's been falling and it's getting cheaper, so to speak. Now it's selling roughly. The DXY sells about 89.2 for whatever that number is. It will fall to below 80 or into the 70s within the next several years. That will make everything an American buys a lot more expensive. It will make things we produce here a lot cheaper. So that, to me, if that happens, then people will say, well, if I'm going to lose 10 or 15% just holding dollars, why would I want to hold dollars? So that will exacerbate that situation. If you look on a trading basis right now, one of the biggest trades out there right now is most people are short the dollar. It's it's sort of a very one-sided trade. So you might get a pop in the dollar over the next 6 to 9 months, but after that, I think that the long-term outlook for the dollar is it goes down a lot lower, and so any dollar assets that you hold will go down, especially if you want to buy, anything that's made anywhere else, and you use your dollars, it will cost you a lot more.
So just so people get a clear picture of this, when the dollar, completely falls apart, let's say, and you're saying if people are holding dollars, and you're saying our lifestyle is going to change. I mean, when you say this, so people understand what you're talking about, what do you mean by our lifestyle is going to change? I mean, I won't be able to go to the supermarket like I always do and buy the bread for, $3 or $4. I won't be able to buy the car and get a loan for it. I mean, will people still be able to do all these things, or are you talking about something?
They will be able to do those things, but they will only be able to do them in smaller quantities, because anything you import will be costing you more. And that, so if your income is let's say your income is at $1, and you go out and buy a loaf of bread for 10 cents, and that loaf of bread is now 15 cents. Well, something else in that dollar has to give away. You don't have that 5 cents to spend. And that's what's going to happen. As we keep importing stuff, because we don't really make a lot of stuff here anymore, everything will cost you more. And, there will always be people that will have the money to afford it. But for the average person whose wages have been stagnant for 30 years, their lifestyle will get, that will be compromised to a point where, I don't know, it's going to be very unpleasant for those people.
And at what point then, as the dollar continually, declines, like we're saying, at one point does the government, the Fed, what point do they step in and say, okay, something needs to change, or they just let it, slide?
Well, that's how war starts. Historically, when you have, go back to World War II. Japan was moving, expanding in Asia, and we embargoed the oil that Japan needed. So they really had no choice but to start a war with us, whether they were looking to start it later on or whatever. They were forced into a war, and wars historically are economically dependent. And Germany started to expand because they wanted to keep people employed. And why did that happen? Look what happened after World War I. You had, in Germany, people were using wheelbarrows full of paper to buy a loaf of bread. In Venezuela right now, people are going into a store with paper and they're putting it on a machine to weigh it and not count it. So I don't know if we ever get that bad, but it could get pretty hairy. And I don't think the government can do anything about it.
Do you think that they'll move to maybe say, okay, we're going to cancel the debt. We need to restart the system. We need to rework our entire economic structure. I mean, they're going to have to, something has to be done, right?
Well, historically, that's what happened. I mean, if you go back to every major power in the world historically, going all the way back to Rome, first thing they did was basically debase the currency by, instead of putting an ounce of silver in it, they put, half an ounce of silver and some other metal in it. And people realized that it wasn't all silver or whatever it was. And then they rack up all these debts. And sooner or later, you have what they used to call a debt jubilee, where they pay the bondholders, 60 cents on a dollar, 70 cents on a dollar, 50 cents on a dollar, or whatever. And then they start the system all over again. You just don't want to be holding those securities when that happens.
So what should people hold? I mean, if we're approaching this, and how should people prepare for this? I mean, what should they hold then?
Well, I think, and I don't like people to refer me to as a gold bug, but I think that we're getting to a point where precious metals or anything that has historically held value is something you should have as part of your overall portfolio or as your just holdings in general. Paper money is only good if it's backed by something. In 1971, Richard Nixon took us off the gold standard. And now the U.S. currency, it says it right on the bill that you hold, is backed by the full faith and credit of the United States. Okay. Now, as long as the United States has lots of credit, then you don't have a problem. But if the United States runs into a problem where it can't pay the interest on its debt or whatever, and they decide that they are going to say they're going to default on their loans, look, Argentina has defaulted probably 4 or 5 times. Other current countries around the world have collapsed and refinanced several times and gone into default where people get 30 cents on a dollar, 40 cents on a dollar. People that own Puerto Rico bonds are now, probably going to get 40, 45 cents on the dollar. And, then you start all over again. I mean, just think, last year, Argentina, a serial defaulter historically, was able to sell 100-year bonds at about 7.5%. I mean, think about that. Here's a country that has defaulted a number of times. Why would anybody buy those bonds? And the reason people bought those bonds, because U.S. Treasuries were selling at 2%, German bonds were selling at, in some cases, negative rates. So while things look good, 7.5% versus 2% sounds like a pretty good deal of a sovereign country, not realizing that that sovereign country has defaulted in the past. So that's the state of affairs that we're in, unfortunately. And I don't know how it ultimately ends, but those are the kinds of scenarios that we will face. We will probably face some sort of default, some sort of recapitalization, some sort of repricing, and we'll start all